Should you go into private equity? Hello and welcome back to the channel, guys. Today, in this video, we will be discussing the reasons to go into private equity from the investor's perspective and the career perspective. In addition, we will be talking about what it's like to invest in a private equity fund and work in a private equity firm. And to remind you, as I always do, this video is for educational purposes, and everything I'll be discussing has its basis in research and practical experience. First, we have to know what private equity is. To answer this question, private equity is a type of fund just like the hedge fund, venture capital, and real estate funds. Private equity consists of funds and investors that put their money in private companies or engage in buyouts of public companies. A private equity fund has limited partners who typically own 99% of shares in a fund and have limited liability, and general partners who own 1% of shares and have total liability. Private equity is an alternative form of private financing away from public markets, in which investors directly invest in companies or engage in buyouts of such companies. Private equity firms mostly buy mature companies that are already established, and they buy 100% ownership of companies in which they invest, meaning they own all the profits from that company. In contrast, in funds like venture capital, investment is made in startup companies, and they put in mostly less than or 50% investment, so they don't own all the profit from these companies. Now that we've covered the basics of private equity, let's take a look at hedge funds. According to Wikipedia, a hedge fund is a pooled investment fund that trades in relatively liquid assets and can use more complex trading, portfolio construction, and risk management techniques to improve performance, such as short selling, leverage, and derivatives. Hedge funds are regarded as an alternative asset. Hedge funds are also considered distinct from PE funds, as hedge funds generally invest in liquid assets and are open-ended, meaning that they allow investors to invest and withdraw capital periodically based on the fund's net asset value. In contrast, PE funds generally invest in illiquid assets and only get a return on capital after some years. As a result, hedge funds are considered riskier investments compared to private equity or PE funds. Having said all these, we can see the differences between PE and other types of funds. Private equity is the ownership of private companies or private assets by special firms. These firms pool a lot of capital together, and they invest it in various companies. After gaining total ownership of these different companies, they grow these companies and then sell them for a higher price with the aid of investment bankers. The money for these deals is raised from various investors and small funds like growth equity, mezzanine funds, and so on. Also, private equity investing has a long timeline before getting their returns back on investments. Private equity firms sometimes wait for 3 to 5 years before they make their profits. This extended timeline has a lot of risks embedded in it too. After all, disaster can strike the company before it is ready to bear fruit. And so, it becomes clear that private equity investing isn't a field for the anxious or the impatient. Now, why should you go into PE as a career? The private equity world is quite competitive simply because it needs fewer people to be successful. Each PE firm has a specific number of associates it needs, and there are a lot of people trying to get into PE firms. These range from bankers to MBA holders to wealthy investors to a whole lot of other people. As a result, private equity jobs are some of the most sought after and competitive careers in finance. And to work in a PE firm, you should have special financial modeling skills, LBO modeling skills, M&A modeling skills, and general financial analysis skills. Private equity is one of the most consistent high-paying jobs in the entire world. If you are working at a mega private equity fund as a top PE associate, you can typically expect to make between $300,000 to $350,000 a year. Of course, the pay scale of these PE firms depends on the type of funds they are dealing with and how huge they are. So the main reason everyone is trying to break into PE and why you should go into PE is that it has many great opportunities. You get to learn about businesses, you get to make actual investments, and the pay is quite decent. Altogether, private equity firms manage nearly $1 trillion of investment capital, which they put to use through strategies such as direct investment in private companies, leveraged buyouts or LBOs, sometimes even partial stake purchases in public companies. So, this means that whether you are an associate or a principal or a partner, a private equity career is gratifying both financially and intellectually. Now, having talked about why you should go into PE as a career, let us look at the reasons why you should invest in private equity. First off, private equity has proven to provide far better investment returns than stocks and bonds and other forms of funds. According to InvestX, private equity has had an average annual return of 10.64% over the past years. Moreover, private equity provides improved portfolio diversification, which decreases market risks. Let's take a moment to break this down. First, private equity investments are usually not that correlated to the market. Investors who watch the market know that it bounces up and down all the time. This fluctuation can be so stressful, and it often spurs investors to make emotional decisions, thereby selling at the wrong time. Having a diversified portfolio will smooth out those bumps, and this is something private equity provides. Therefore, you don't lose money every time the market goes down. Private equity is also known as an alternative asset. PE lets accredited investors and institutional investment firms diversify their portfolios and take on more risks in exchange for potentially higher returns than they might get by investing in public companies. Investors turn to private equity firms to diversify their holdings and aim for higher returns than the general market and other types of funds might provide. And while private equity funds come with higher risks, historically, they have been seen to result in higher returns. The fundamental reason for investing in PE is to improve the risk and reward characteristics of an investment portfolio. And finally, private equity offers the investor the opportunity to generate higher absolute returns while improving diversification. Having discussed all this, we can all now see that it's safe and advisable to go into private equity, either as an investor or a worker, provided you have the funds and patience for it. PE investing isn't a sure bet, but it will get you farther than basic trading ever could. Have you learned a lot from this video? Is there something about PE investing you know of which you'd like to tell us? Please, make sure to discuss this below. Please make sure to like, subscribe, comment, and share. Also, stay tuned for similar content in the coming weeks. Thanks for watching this video. I'll see you next time.